Awesome. Thank you guys for joining on another Wednesday. I almost said Tuesday because I used to do these on Tuesday. But it is nice to see you all. Hope you guys have had a good week. Looking forward to the week going forward. And Edward here with Kevin as we are every other Wednesday. Um, Going over underwriting, going over deal sourcing, brokers, and really just kind of diving into the general consensus of the hard and not as fun part of this journey we're on is the underwriting the numbers and then finding the deals. We like to call it like the nervous part of the game where you're either newcomers are hesitant to talk to brokers because of the fear of what are they going to ask and the fear of possibly being wrong on numbers, which is it is what it is, you know. um, and just the practice and experience of the underwriting and broker outreach. So happy to see you guys. Happy to be here. It feels like we haven't been here in a while, but it's only been 2 weeks. So yeah, we are going to go through a deal today. Kind of go through the notes of it, any questions, obstacles, what to look for, what not to look for. And just really kind of do it hands on because that's how I learned. Like it is really the best practice of just like doing it and then getting other opinions.
Yep, got to put in the reps. That is the truth.
So, like I said, my name's Edward. I'm based out of the lovely, crazy Los Angeles, California. I run my own brokerage here, Quadriga, and I've been in real estate for about 5 years. Jumped into multifamily space the last couple. Own property here. Hopefully, getting one under contract here soon. That we're actually trying to acquire through seller finance through a friend agent of mine who's also the owner. So that's cool. When just building those relationships, which then turns to potential opportunity. Yeah, it'd be a huge one if we could get this. So really hoping it works out. I'll hopefully have an update for you guys next time, and hopefully a good one.
Awesome.
But yeah, that's a little bit about us and or me and what I'm up to. I'll let Kevin introduce
Sure.
himself.
Thanks, Ed. So, yeah, my name's Kevin Kohler. I'm the director of KW Commercial down in South Florida. And we run a team of commercial brokers that serves the Southeast and really wherever across the country that our clients need us, focusing on multifamily, on hotels, and self-storage facilities. But that's kind of me in a nutshell. And then if you have any more information, questions, or want to connect to a Calendly one-on-one or something, you can scan my QR code there on the screen.
One thing also in the chat, put where you guys are from, and just connect with everyone in the chat. I think it's very valuable, very important. You'll never know what you guys will, who you'll meet, who knows who, and how deals are made in the chats. Even when you go to conferences, they always say the relationships are built in the hallway. You know, while if all the chaos is going on in the main room, you really want to take advantage of the people who kind of know their stuff and networking and really looking to connect with people.
Yep.
MFC is big on that,
And
connecting with people and networking and
in,
doing deals together.
in fact, I mean, Ed, like you and I, it's funny, we were actually talking about this right before we brought everybody in. Like, my team and I were at a conference in Orlando just this past weekend, and I think we spent maybe an hour combined, in the ballroom listening to like people on stage. It was all networking and all relationship building. And that's what it's all about.
Yeah, big time. And the thing is as well, what I love about this space too is if you ask the right person the right question, you'll get the answer that you didn't really realize you're looking for, you know? I'm very big on that. Like I've saved deals that I thought like EMD was out the window, excess of a lot more money than we probably would have like admitted. And we've pulled it off by asking the right people the right questions. And I don't claim to know everything, even though sometimes it sounds like I do. I really just like to believe I know a lot of smart people who know a lot of stuff. And then here's a team. So these are great people to connect with, network with, follow on Instagram, message. Obviously, everyone on this screen is awesome. So you're likely going to get a response. One advice on Facebook, especially, because I know this happens to me being in a lot of these different groups, message one of us if you're trying to add us as friends. That's not I tend to not respond to the request. That's just me personally. And then here's our schedule. As you can see, Mondays, Wednesdays are the best days of the week because you get to see one of us or any pair of us. And yeah, so this is the schedule. As you can see today, so next week you're gonna get the miles with the financing. So yeah, that's kind of what just the intro. We have the ecosystem where you can find us on all the different platforms. And then here's the WhatsApp group chat, which is very important. Another great way to connect. One thing as well is sharing events that are going on that may be in your city, in your backyard, or if you know an event's coming to your backyard or the city you're in, like let people know, be like, hey, I live here. Come, like, let's connect, or try to even set up a group yourself. You don't even have to go to an event, to be fair. Like, if you know people are coming to town for something, like Florida has a lot of them, LA has none in reality. But so all you Florida people, Atlanta, Georgia, wherever, like see when those events are, and just like hang out people during those events. You don't have to go if it's not like your schedule doesn't fit or whatever the case is. You can squeeze a couple hours or during the day and just like, hey, like, let's connect. At the end of the day, people want to go out into town, want to explore the city, especially if it's not where they live. I think it's a great place to also meet people. So yeah, moral of the story is network as much as you can, meet people, connect. Deals will be made in the rooms you least expect, to be fair.
That is the
Let me
truth.
stop sharing. So let me stop sharing this so we can all see each other. Um, anyone here want to introduce themselves? I just like to give like 1 or 2 minutes for people to just introduce themselves, what they're up to, what they're doing, what they're looking for, what their superpower is, and if not, we can jump in. I do know we have some deals to look at.
Well, I guess I can start. My name is
Yeah, definitely.
my name is Shabeze Ebenham. I'm based out of Atlanta, Georgia. So I'm actually an investor here in the Atlanta area, primarily single family, but I'm more so branching out to smaller multifamily. So I just acquired like a triplex, and I actually kind of like the whole model of the multifamily space. So it kind of makes me want to really focus a little bit more on maybe like smaller units, whether that's anywhere from that 8 to 12 range, or anything smaller on that aspect. So that's kind of something I am looking for. And I did come across something that I do want to kind of go on with you guys. But so mainly that's kind of what I'm doing. I'm a buy and hold investor here in the Atlanta, Georgia area.
Okay. So what was your introduction to real estate? Was it the flipping, wholesaling, or
Well,
just the general?
I
Go
actually
ahead.
started out of undergrad. I actually graduated in 2021 at Morehouse College.
Okay.
And I was actually an athlete. So, but the whole COVID thing happened, and we didn't have a season or anything. So
Yeah.
a buddy of mine he've always told me about, this real estate thing, this wholesaling and thing, but I never really paid it much mind because I was really just focused on sports. But luckily, the pandemic happened, and it just gave me a lot of time to actually, kind of focus on something else. And that's kind of where I actually started taking serious. I started off with wholesaling that first year. Did pretty well that year of wholesaling. So me and my partner saved up that money, and then, we kind of moved on to the fix and flip side. So we did a fix and flip here and there. So we did about 2 fix and flips. And with that, I just didn't like the capital gains taxes that came with fixing and flipping. So I'm like, okay, let's do another niche here. So we kind of poured money into, properties because even the deals that we're doing, it's either we can wholesale it, we can fix and flip it, or we can, keep it. So we were coming across good deals. So it's like, why not keep it opposed to, keep selling to these hedge funds, or, and ideally they're the ones really making the money long later down the line. So we kind of got more so on that strategy of kind of burring, in a sense. That's essentially what it is.
That's
So,
great.
it's interesting. Sometimes getting into real estate and taking like that slower approach of the build of wholesale and then single fam or flip, and then like owning one, and then okay, I'm gonna look to 3 to 6, and then now you're talking about 8 to 12. It's funny because you probably have a lot of experience in your space and like in real estate in general, more than you might think based on whatever room you're in, right? A lot of times you get people coming into a room and they're like, "Oh, I learned about real estate yesterday." I'm not saying anyone on this call. I'm just generally speaking, and you'll see it all the time. And I'm like, "All right, cool. So what about multifamilies?" They're like, I just like it. And I think it makes the most sense." And you tend to shoot higher without and not having as much of the experience. So one thing I would say to you, because I've seen this happen a lot, I'm sure Kevin, you've seen it a lot too, where taking it slow by all means, like that if that's the pace you want to go, I would challenge and say like you probably have more capital raise experience, deal identification,
Yeah.
broker experience, identifying like opportunities, getting creative with them, which I think is really intimidating sometimes, especially if you don't know how to pitch it. And then also saying like, hey, I've kind of built that base. Because sometimes people jump into the multifamily deep end as their first go at it, and they're killing it, like absolutely crushing it. Yeah.
Yeah.
Oh, Kevin, perfect. It's like,
Yeah.
oh,
My
I'm
my
gonna
my
start.
first real estate investment was 120 townhouses. Like
So
why do you have to
same.
start at one? Like it's a
Exactly.
limiting belief.
So and look, by no means am I saying don't do what you're saying, because at the end of the day, like there's nothing wrong with that. It'll work.
Right.
Like especially because you have the background for it. But if you're like, hey, I eventually want to get to 100, go for 100. Who cares?
Yeah.
You can go for 100 and do a flip every quarter if you wanted to.
They're all investments, like they're all investments that provide returns. So whether it's a flip,
Mm-hmm.
whether it's a buy and hold, whether it's buying a duplex, quadplex, 122,000, it doesn't really matter. Like it's all still creating revenue. So what
Two
what's
things.
good, what's good is
Oh,
that
go
you
ahead.
can find it's okay. You can find those flavors that match what you're trying to do and what your vision is, and that's what's important is staying true to your core and what your vision is going to be. Because without that, you're going to lose the steam, you're going to lose the motivation. So I like what you're doing, man.
Two things I want to add real quick to that is, um, you just mentioned capital gains. You'll get the best ability to play that game, for lack of a better way to put it, on higher scale. Because
Yeah.
cost segregation, depreciation, X's and O's that we've briefly discussed, but I kind of leave it to professionals on. And then the other thing is, kind of slipped my mind, but what I was going to say is regarding that is on the multifamily scale, and like once you do go fit, oh, here's what it was. When you're looking at the deals, obviously the capital raise is the biggest elephant in the room usually, because that's the biggest. It's very intimidating, to be fair. But all you're doing when you're looking at multifamily that's on the bigger scale is you're just adding extra zeros and commas. It's the only difference. I can underwrite 1,000 units, or I can underwrite 10, and it's really just an extra zero here or there and a comma. Other than that, it's the same thing. Sure, the capital raises a lot more, but if the deal is good enough, that'll come. And then that goes back to my networking thing of connecting with the right people. If the opportunity presents itself, the deal will kind of figure itself out.
Yep. So
So I think you're on mute, but and obviously I know since this is being recorded and being shared and whatnot, you can share as much of the information on the property as you want. If you still don't have it on the contract or acquired it, like you can run numbers. I can plug them in to this
Oh yeah.
while you're doing that. So just whatever you feel comfortable with. And then this will also be a good way to kind of know like what are we looking for right off the bat when we're underwriting, and kind of where we um like what are the first key numbers you're gonna look at.
Okay, this calculator looks a little different from the last one I got. Okay.
this is an advanced calculator for syndications.
I couldn't do it on this one. Where oh, here it is. So this one's a lot
It's
simpler.
6 units, right?
Yeah,
Yeah.
6 units.
Yeah.
So
And
this
then
one's a lot.
I'm sorry, Ed, you said it's
Yeah.
you and one partner.
You said what, sir?
It's you and then one partner.
Right.
Okay, yeah. So it's like a JV setup. Go ahead, Ed.
So this is kind of just like my rough draft one. Because especially on the smaller units, I find this to work well unless I'm really like going far into it and like getting more serious about it. And then also to the point of like the size of the deal is relevant to the calculator you use and how many partners you have. You could still do it on other calculators. It just takes a lot more tweaking that I don't want to confuse everyone on. But this is something that I've used and like kind of tweaked myself and played around with. And just get a general idea of like how to quickly glance at it and like get your spark notes on the deal. And general idea. So let's start with the acquisition price.
Okay, so seller wants about 700,000. So it's a 6-unit. It's actually 100% occupied. They're all 2 bedrooms, 1 bathrooms.
Okay.
They're all right now. She's collecting rent at very much below average market value. So she's collecting $800 a month on each of these current units.
So what do you think market value is at if she's
Market
getting
value
800?
for a 2-bedroom, 1 bathroom, that zip code is at 1,600. So she's right about half of that.
So what was your data source for that? Because I think that's important.
So I use a HUD user, and I
Okay.
I tend to take about 90% of what HUD user is, and 90% of fair market value. Well, I should usually put 14. I should really put 1450 for market rent.
Okay.
I take about 90% from the fair market value.
So
Okay.
your market value is based upon what Section 8 is paying.
Correct.
I like it.
Okay. So here's another thing too. Like you make like on a 6 unit, that's gonna matter every $50, every dollar matter. Now imagine on 100 units. That's gonna matter a lot more. And that's why we asked that question of like again, you guys have heard us talk about this a million times. Knowing your market, going deep into it, and making sure that your comps are fair. Like on a 6 unit, you're less concerned. See, to be fair, you're less concerned about the amenities like a gym. It's less likely. Is it impossible? Absolutely not. It's just less likely. But when you consider like, okay, those comps, do they have washer and dryer in the unit? Do they have a pool, which could be a factor? Like, especially here in LA where it's hot all the time, that's a big deal to some people. They're willing to pay extra. You can even go as simple as, does that include parking? Right? And that's where we say do like the silent shopping, property management, whatever it takes to kind of like whoever it takes to ask essentially to and again that'll go once you are more serious about the deal and you gain a little more momentum with it so that you're not doing days worth of research every time you find a deal, which obviously would take a lot of time. And that's where this plug comes in. Most of the time, you're not going to, on the smaller ones, it depends your location, but you're not often going to have additional income. Sometimes it'll be like utilities or parking or storage, stuff like that. On larger complexes and bigger buildings, you're going to have more of that, and it's more evident because you have more stuff being taken care of by ownership. So with that being said, do you know if there's anything that's collecting additional income or?
Not necessarily. I think all
Okay.
of the units pretty much have their own washer and dryer system, so it's not anything that additional like parking or anything. So
Got it. Okay, cool. So we got that. Here's another one that gets a little tricky too about knowing your market is like what's the market vacancy? And that's just more location based. On the smaller side, yeah, you can do like 6% is fine, I guess, for now, and kind of go from there. Because you're hoping to not have a unit sit for more than a month
correct.
when they vacate.
Yeah.
And especially on smaller size units like this, like the one I'm looking to acquire, they've been there between 7, 10, and then actually since day one, which is crazy. I was like, you could have owned this building almost twice over. That's nuts. But exception, most likely, ideally. Here's the fun part, and this is where I'm curious to see where you're at with this process. How are you planning on acquiring it from a debt and down payment structure?
So my thought was, my thought was to actually probably get into it through a hard, because normally how I get into my deals are through a hard money loan, and then I raise the money for the down payment, of course, as well as expenses, and then cash out after that. So ideally, that was kind of the structure I was looking forward to.
Okay, so what's your turnaround on that?
In terms of the, and see, that's another thing. In terms of getting these, because like I said, it's already 100% occupied now. So it will have to be a thing of one, giving the tenants time to actually relocate, because I'm pretty sure they might not be able to even,
Are they month to month or are they leased?
they're month to month as of right now.
So then they only need 30 days.
Yeah, exactly. So they need 30 days. Yeah, so we can
Not
go in.
if you're in California.
So true. Yeah, depending on your
I'm traumatized by this. So this is.
that's
Are you sure 30 days? Like, I wish it was 30 days.
if it's
But
month to
anyway, go
month, then
ahead.
they got the month. You just give them 30-day
Exa-
notice. I mean, during COVID in
Exactly.
Florida, I went to 60 days, but that's already been rescinded.
Yeah. So, s- um, so I know Kevin, I think you want to jump into it. You had something to add in regards to like the acquisition.
No, not really. Just what I
Okay.
would have said though is like, so you have a strategy right now that you're talking about. It's hard money and then bird out.
Correct.
However, have you ever looked at, because again, this is 6 units that is occupied. Have you looked at a DSCR loan?
I have not.
Okay, so we can connect you some people that can give you ideas on that. Because again, that could be a much lower interest rate where you don't have to do the refi part. You just get the loan, you renovate it, and you're cash flowing.
Okay.
So,
Save
so,
on the
so
additional
yeah,
interest.
that's what I like about like this space is like we're gonna get a lot of different ideas and we go a lot of different directions just on simple stuff like this, but it's like gonna feed into something else, right? And then also here's something else that like right off the bat for me is um the debt is such a big part of it because of your timeline. You never know what could happen. Hard money, like unless you lock in for a couple of years, I would say at least, and hope there's no prepay or work out a situation when there's no prepay. 1 year, you never know what could happen, right? Do we think rates are going to go down? Ideally, yeah. That it looks like that's what's going to happen. I don't know, but until you open a wall or the floors and whatever, years sounds like a plenty of time, and then the clock starts ticking. You're like, wait, what? Like that,
Yeah.
it's intimidating in that sense. Also, regarding because you have so much upside on the rents, um, and now again, your hard money lenders and whatnot. Also, with the tying up the money, 6 units is hard to schedule. I think it's the best way to look at it in that sense. So, especially if you're borrowing money, raising the money, and you don't have like a real set timeline, it's better to under promise, over deliver. That's what I was looking for. So let's just go off of what your initial thought was and kind of see how that looks. What is the normal deal and setup you have with your hard money lender?
Um, so right now I usually get about 90% loan to cost.
Nice. Loan to cost. So what is okay?
So
That goes to a
it's either
question
the
actually.
it's either
Do
the
you
lesser
have a estimate on? Oh, sorry. Go ahead.
it's either the lesser amount of the loan to cost or the lesser amount of the LTV,
Got
which
it.
usually is LTC.
Yeah. Okay. Do you have an idea of what the capex will be, which is the rehab budget essentially of the units?
Yes. I was on the high end, I was thinking about 12,000 per unit. So that's roughly about like 72,000.
Yeah. Okay. Um, so upfront, you're putting 10% of your total, so 72. That's gonna factor in essentially another 10%. So your loan is gonna be right around actually 700, to be fair.
Right.
Yeah.
Yeah. That sounds about right.
Okay. So what I'm gonna do is I'm actually going to add it here. Remove this. I'll add a 5 here. Loan amount 90, equity 10. How much do you usually pay your investors on the borrowed money?
I usually give them about 12%.
And is that okay? And you're gonna get that all up front, so that's gonna be essentially your preferred interest.
Right.
And actually, what's the rate you get on the hard money?
The last rate I just got on my hard money was about 11.9, so about 12%.
And do you have any points on that?
Yes, we have. Well, my lender gives me about 1 point, so roughly about 2 points.
2 points. Okay, so I'm gonna add 2 points. So that's 14,000. So we're gonna jump that up to 790. 12%, and I'm actually gonna shift this from loan amount to seller carry amount because just for my headache's sake and time, the seller carry in this calculator is interest only. My mortgage is not interest only. So instead of remathing everything, I'm just going to plug it into the seller carry, even though it's hard money, same thing. Because the numbers all go to the same place. Expense ratio, I'm not too familiar with the area. Kevin, I think actually Kevin, this is a good time to kind of go over real quick, like just generally like expense ratio. What is like the bare minimum, especially on smaller units? I think you'll have a better idea of what it is out there, like on a 4 to 8 unit, let's say.
Yeah, I mean, you ideally you want it to be under 40%. I know that a lot of times people try and say something under 50, but in my opinion, for a smaller property, single family, duplex, quadplex, etc., you want to stay somewhere around 40% is your goal. And even if it ends up a little bit above that, that's okay as long as you have a path to drive it down.
Awesome. So one thing to look at here, and I think this is big too. Day one, just given the way you're acquiring this, it's gonna look ugly. Like there's no way around it because your interest rate's high, your interest only. So even on the back end, it's not gonna look. Or because you're trying to keep it, like you're not really concerned about paying it back and the interest only because it's a quick turnaround. You're essentially taking a more like single family approach to it. So day one is gonna look ugly. It's the reality of it, right? And then you also have the low debt. So we know that you're going to be basically having to come out and refinance about 700, well, actually, probably the entire acquisition. So on the back end, you're going to have to pull out 790, right?
Right.
Okay.
Right.
So just to make it a little simpler, we'll come here. So here's a question. When you do the burn method and you look to do that refi, do you do you usually try to get more than the loan and pull some money out of the deal? Or do you usually just do whatever it takes to break even?
I usually try to get more out of the cash out. Yeah.
Okay. And okay, so now this is where I like this conversation to open the door so now everyone can think about it from their perspective. What type of investor are you? The person who's like, I don't need this to cash flow a lot. I just would rather have cash on hand because there is that trade-off. Remember, that's always going to be there. And then I can go do more stuff with it. Or you're like, hey, I would like to have a little bit of a buffer here on the cash flow. Obviously, you're going to have a reserve, which you should have for every deal you do. But like, hey, I want X cash flow per deal for it. Like, I want that coming every month. What type of investor are you? And I want each of you to kind of either plug it into the chat or think about it yourself. Or if you've never thought about it, I think it's a good question to ask yourself.
Yeah, I'm also a little bit in the in between now, but when it comes to like prior to like now, like most of my deals prior to, I was more so trying to pull out more money to have more money in reserves to dump into another project. As
Okay.
well as still cash flow a little bit, not worry about too much of the cash flow on that aspect.
So here's an interesting thought too, generally speaking, because the more this happens and the more deals you do, the more this shifts. The more access you have to private capital, the less you are concerned with how much money you're pulling out of each deal. Because as long as you're breaking even, obviously, you have to cover all those initial costs. And then the next objective is cash flow as much as I can, or yeah, essentially just cash flow as much as I can, because I know I have people backing me. And especially think of it now on the scalable sense. If you're investing in a deal and you're running a deal, 100 units, let's say, the investor that's going to want to reinvest with you is the person that was able to get the returns in the latest the time frame you said, but also got a lot more benefits beyond that. And they're more likely to be like, hey, you delivered, you proved what you said from day one, and now I want to reinvest with you even more. And that's how you build those. And that's why you'll see the just an easy name to throw out there. Grant Cardone can snap his fingers and find millions of dollars, because once he built that track record and done enough deals, people are just going to be like, look, don't even give it back to me. Like, I just trust you. And funds are kind of like that. I'm not going to go down that rabbit hole, but that's kind of how it starts. And I'm sure you had to go through that, where in the beginning, it's a lot harder when you're raising that private capital for your deals. And then once you have that proven track record, there's a lot less questions, you know? So that's how kind of it all ties in. And I like that we went that direction. So now we're going to play around a little. Now this is the fun part. So having the numbers I have here, I have the original, so that hasn't gone anywhere, right? I just made a copy of the calculator. And I recommend this and suggest everyone does this, is when you kind of plug in all your base, like you're at square one, like, hey, this is my middle ground, make a copy of the spreadsheet and just start playing with it, like seeing what happens when you change X and O, right? So I'm going to actually change this to the total purchase price of, let's just use this 841 number. Hypothetically, let's say it's a stabilized value. Let's put 845. Because the all-in was 790. So now I need this loan, which is actually now going to be in mortgage, to be 790, which is actually going to be pretty high. And honestly, I think you're going to need a little more. And I think you will get a little more. Let's see what happens if I do this. And this is me, especially early on, where this is all I did. I just changed numbers and see how it would change everything, because that was fun. And it actually made it a lot easier to see how the numbers work, what affects what. Especially on the more crazy calculators like this, where you have so many numbers you can change, it really helps with like, all right, let's just see how this goes and see what happens. So here we're gonna go to 790. Oops. Okay, so you're gonna be around here, let's say.
Okay.
If you're hoping you're at 6%, you can see how that looks. But now here's the good part about it. You're not paying a pref anymore, right? You're paid back, your money's paid back. You don't have to really worry about the interest. Here's another question for you now. Do your private money, whoever you used to get into a deal, do you give them any ownership on the back end when you refi them out?
No, strictly
Okay.
cash on cash.
Just transactional. Okay. So now looking at it, your debt's covered. Obviously, the interest rate's going to be a factor in this. So I guess it's called 6.5. Actually, that's just because I like the number more, let's leave it 6. And essentially what it is now, you have a property, all your money's paid back. You have equity in the game, which you're gonna always have to have. One thing that's really important though in this space, especially when you're looking at a commercial loan, 900 probably is not going to be the valuation that's going to be enough to get you your full 790 back, because you're going to have to leave money in the deal. Well, there's going to have to be that spread, which is considered the down payment technically. So in this sense is, I think your entry is a little over leveraged personally. And trust me, I'm the person who try to over leverage as much as possible at times. But where that comes into play is leaving some money in the deal, which may not always be a bad thing, or you're not as cash flow positive after the fact. And then that again goes back to your strategy. Because
Yeah.
to some people, owning a negative asset, cash flow asset on paper is not necessarily a bad thing, right? Especially if you believe in the area.
Yeah, some people would take that loss, but it's because it's piled into their portfolio differently, and they want a little bit of a loss to help their taxes. But I mean, to me, like, there's a lot of red flags just with break even occupancy being so ridiculously high. You every
Well,
time
this is on the older end. So I'm sorry, let me clarify that. I'm more focused on this because this is the new rent amount. This is what the old value was. So I'm not really looking at this side. I'm more looking here because this is what my
break even occupancy is 97%.
correct. Yeah.
So
Just for everyone else that saw this number and got scared.
well, they should be scared with both. So like break even, like I wouldn't buy it. So like, I mean, that's my personal opinion, right? Because break even occupancy, you have somebody move out, you're already not breaking even, and then that's just more stress. And then what about if you have to repair something when they move out, et cetera, et cetera. So this is they need to shift their asking price.
So I got a question. Where did you guys get the value from? Because I'm seeing on the performance side, I see a stabilized value at 841.
So that I didn't look at. Well, again, that's really based on what the cap rate is in that area.
Okay.
Do you have that number?
I believe it says 6%.
6? Okay.
Which will help.
Yeah.
But you also want to assume, even though it wouldn't be true, when you're selling a property, I mean, this is a hold, so it's a little different, but when you're selling, you always want your sales cap rate to be higher than your acquisition cap rate.
Gotcha.
You never want to assume the market will allow compression of cap rates. You want to assume the worst, and that way, if good things happen and the market tightens, then that's just more money to you.
Yeah. So this is like essentially going to the point that Kevin was making. The way that this would work is like, let's say you don't do the traditional burn model, but you do kind of like a hybrid where it's, hey, I'm doing the burr, but you're still keeping some skin in the game. And now where that's going to help you a lot with is the concern that Kevin brought up, which I agree with, because this, this obviously if you've flipped and owned property, it doesn't matter if you rehab something yesterday. Until someone lives in it and turns the faucet and turns the light on, and whatever the case is, something can always happen. Especially stuff you have no control over. So I do agree with the sense of like, you don't want that to be the cause, especially if they've tended to been there a long time. Like, you don't want to be that close to break even. So let's say you leave 70,000 in the deal. Your entry point at that point, hypothetically, for the overall deal and the value, like let's say we even go off of the 6%, it's actually worth 980. Your entry point is far below 10% of like your skin in the game, your cash flowing, like 600. And let's say you want to reduce your risk a little more. Okay, then leave more skin in the game, and that just goes back to the appetite of the investor. So in the model and in the idea of like, I'm very big on the idea of there's a way to make a deal work depending on how you approach it. Now, price is a very big factor of it. Let's say here, you don't pay 700, you get it for even, let's say, 30,000 off. That changes your entire landscape because now you need to burn less money out, like on the back end. That's my biggest concern. I'm always more concerned of what is my exit and less concerned about the price.
Right.
This deal I'm hoping to buy soon, the 5-unit. I told the guy, the agent, seller, and a friend. He's all those things. I don't care the price. You can tell me 100 more, 50 less, 200 more. I don't care at all. I care about the terms. Like, what is the seller finance model that you need? How much do you need down? What is the interest rate? What's my balloon? How flexible are we on the back end? That stuff I care about way more than the price. Because realistically, in 5 years, that 200,000 is nothing. Mind you, the property's valuation is 2 point, and originally he's asking for 2.8. So when I say it like that, it's 10%. not going to change the deal too much in my situation. One, I have multiple partners in this deal. It's a family thing. So we have multiple people involved. The risk can be mitigated, carrying costs can be mitigated. The other thing is because it's interest only, that saves a lot. We're not at 12% interest only, which is different in your situation. We're 5%, which is very big difference. But yeah, so this is how you can kind of play around with that. And one thing I like to do too, especially with your model, I'm not going to do in the SDA one because it gets very complicated with the setup you have, but or with the smaller unit, and I don't want we don't have enough time for that today, but we can play around with that later for you. Is run the numbers as is, kind of get a feel for what your cost is, getting into the deal, how you're going to float the cost during the deal. And then like, okay, now that I have painted the picture of what today looks like, re-underwrite it for what it's going to look like after the fact. Then that gives you an idea is like, okay, the headache I'm going through today, which it's going to be a headache. You've done it with your flips. You're buying it, you're opening the walls, especially include 6 tenants. Good luck. I mean that nicely because it's a good problem to have. Yeah. And then it's like, okay, let's play around with what is it going to look like in 2 years? Is that in between worth it? Is it return worth it? Are the investors or the private money willing to wait that long? Is another big part. And is that even fit their timeline? Like you may have always told your investors or private money people, hey, give me 3 months, give me 4 months, max, worst case scenario. Now it's like, hey, give me 2 years. That's a different tone. Right. That's like you're it's new money now, right? It might not be the same guy before. Obviously we hope it is because that's easier for you, but that's just the reality of it. That stuff changes very quickly. I know we went a lot on it, but I feel like this is the type of stuff that like it just shows that 6 units, 600 units, 60 units, it doesn't matter. Really what the idea is just understanding the small details and kind of how to navigate is how it works for any size deal, in my opinion. So I do appreciate you bringing this. I enjoyed this. Time flew for me. I didn't realize we had 10 minutes left, to be honest. And this stuff's cool. So I'm going to open it up to any questions. Obviously, you can go first since it is your deal, but for anyone else who just general questions about underwriting or kind of stuff we're looking at and talking over today.
I guess my last question will be just more so like, I know like when it comes to multifamily, like the value is really determined based upon the income of the property, correct? And what they're
especially when you talk to a lender, yes.
Correct. Okay. I got you.
And also that's the thing too. Actually, I'm happy you brought that up because on the back end, you're not just gonna go to a traditional lender. Like Kevin mentioned earlier, you have the DSCR, you have a lot of options for your debt. Make sure you kind of check those boxes and see what they're gonna want, require, like how to qualify X's and O's and like what. Like basically get a debt quote. So you know what you're working towards. The last thing you want is to get to the goal line. You're at the 2-yard line, and all of a sudden you get a surprise like, oh, by the way, you have to do XYZ. Like, cool. I would have loved to have known that before I opened the walls or before I closed the walls. To be fair, right? Because there's every county zip code. Like Kevin with property management, you see this too. Like there's no 2 locations that are the same. You can cross the street and all of a sudden they're like, good morning, you have new rules, or it's different than the other side of it's like, wait a minute, time out, hold up, like what just happened? And then you're stuck. Like, what do you do? Right? And that just costs time and money. So anytime you're looking to do this model, it is very important to kind of have everything like kind of over planned out. Don't stress yourself out or feel like you have to know the answer to everything. Don't do that. But be like, hey, if I want to do this simple thing, I call it simple because you think, oh, it's just a refi, but it's also a very big piece of the puzzle. Like without that, the whole thing collapses. How do I do that in 2 years, a year and a half, even whatever the case is? And then you get all those answers. I'd ask like 3 people, probably 2-3 people. Then you know for sure, guaranteed, if you do XYZ, and tell them your plan. Like you don't have to be shy about it. This is the situation. This is the plan. This is the end goal. This is what I need out. Cool. Is it possible if you do this? Or no, it's not. You'll be here. and then you can re-underwrite the deal to fit what they tell you. And luckily, that's the type of thing where you build a relationship once with the right people. You have three, let's say 2 to 3 lenders. Then you don't really have to chase after that to get that information. It's, hey, quick phone call. You have the numbers. You know what they're looking for. They know what you're looking for. All right, I'll have an answer for you in no time. So that's the thing too. The qualifying process is definitely a lot harder. Shoot, I'm in that predicament now with the commercial property. I'm like, someone give me a loan on it.
Yeah.
It's pain.
All right. Thank you guys though for taking
Yeah, my pleasure. Thank you for just being involved and sharing the deal with us.
No problem.
Yeah, it takes a lot
Yeah.
to bring a deal on a live Zoom. So thank you.
I'm actually going to stop the share so we can just all see each other. And I believe we have another question.
Yeah.
Hi. Question about when underwriting and needing to determine like the price of insurance. So I was underwriting a deal recently and I saw that they're from the T12 what they paid for insurance per unit, and then I kind of increased it. And when I talked to somebody, I haven't talked to a broker yet, on insurance broker. So that was one of the questions I put in the chat was, does anybody know names and contact info for an insurance broker? Because I know that I can't just like go online and ask for a quote because I have to build that relationship.
What state?
We're looking in Oklahoma.
Okay. I do not have any brokers in Oklahoma, but you have to
Okay.
find state specific.
That was going to be one of my other questions. So it is state specific. Perfect. And then I just wanted to give advice that I was given. Basically, it killed the deal when I redid the insurance. Somebody had advised me to double it. So it looked great until I doubled the insurance cost and then killed the deal.
I would assume that the doubling of insurance in Oklahoma is less likely than it would be in Florida, right? So don't take big suggestions like that on face value.
Okay.
I would say when it comes to insurance, so like in Florida, especially where I'm at and my team is based, we deal with this all the time where most brokers are like, hey, I can't even quote it for you unless you actually have an updated appraisal, like because for Florida, it varies thousands of dollars per door, based on the area of Florida. However, I'm also underwriting a 700 unit deal in Georgia where the total per door cost is going to be updated at around $700. So it can be a wide range, and that way it's something that you don't want to just generalize nationwide or anything of that nature. So with Oklahoma, like what is the current insurance per door cost?
Currently it's like 911.
Okay. And then have you been able to actually see the policy document, like anything of the policy?
No.
All right. So do you know when the policy was written and paid for?
I do not.
Okay. So those make a little bit, some differences. If the policy, maybe they just renewed it at that, that number, then you could pretty much use that number, maybe plus like 5% or something as a baseline, but definitely, well, if it's about to get renewed, then of course that gets thrown right back out the door, and you maybe have to add a couple hundred, but maybe not. And that's why, yes, if you're looking at deals in Oklahoma, start kind of pounding the pavement a little bit and calling some different commercial insurance brokers in Oklahoma and build that Rolodex a little bit so you'll have 3 to 5 people you can call on when you get deeper into a deal. And they might be able to advise you better than saying, hey, we need to see the appraisal, because maybe it doesn't fluctuate as wildly in your area as it does in mine.
Thank you.
Yep.
I definitely agree with that. And I think one more thing too is you want the nice surprise while you're under contract, while you're in escrow, while you're getting these quotes. You want the surprise of, hey, we saved from our original underwrite to, hey, we're more by a lot, and that changes underwrite. That's scary. So it's like there's two. It's like this with a lot of things where you have to get a quote or reliant on things out of your control, unfortunately. But there's a camp of you can be safe, but not you don't want to be so safe you kill every deal, which can happen, to be fair.
And many
Or
teams
the
can.
yeah, yeah, exactly. Or the I call it, Kevin, don't kill me for this. It's like the listing agent one was like, yeah, it's only this much.
Right.
In reality, it's never that. And you're just like, thanks, but that means nothing because
Yeah.
it's not your problem. It's the bottom line. It's like, hey, this information is cool, but if it's not accurate or like I'm relying on it, are you gonna feel the difference? No? Okay, then I don't care. Like it's not your problem at that point. So there's the way to relax the approach. So
I agree.
yeah. So it's definitely the fun whole run around of insurance. See, insurance is the trickiest because tax is pretty straightforward. You know it's going up, and you know it's fairly around what percent it's going to be. Insurance is the most stressful one, I believe. Like even just getting a quote. Heck, in California, you can't get a quote for anything, and half the time I don't know why, but whatever. um, and Florida, like Kevin was saying, like with that Florida deal that's a fun one to navigate. But also again, it goes back to relationships, like having people available that you can get a quick answer from, but accurate. You trust them. You know they're trying to have your best interest. They want your business. They're gonna earn it, and I think that's a big one. And also, because insurance is such a read between the lines kind of business where you want to make sure what you need is in that policy is because of just too much liability, too much risk or something to go wrong because it falls on one person or team, GP in that sense. This is Oklahoma, you said, right? Someone in
Yeah.
the chat's asking. Yeah, Oklahoma. So it is definitely have that checks and balances. How many units is it for, if you don't mind?
60 units.
Okay. So yeah,
The other part about the insurance I had a question about was when you're getting the policy, is it just for the property, the asset itself, or do you also get like landlord insurance?
What do you mean by landlord insurance?
I think, where did I read? It was something to cover against like
General liability?
general liabilities, I think. Yeah.
You must always buy general liability insurance.
Okay.
and then
100%. Property
then
and general liability, always.
and every renter will have renter's insurance. Make sure you're additional insured. Um, Another thing, are you're gonna have a property management company, correct? Ask them. One thing, one trick tip. Credit to Kevin again. Um, Ask property management. Ask other people who are going to work with you on like other vendors, essentially, like property management, contractors. Ask everybody. You
Yeah.
can never have too many contacts.
And on that, I mean, what Ed's alluding to a little bit, and if anybody has to go, we appreciate you coming with us here. But
Oh, damn.
on our property that we had just closed, it was in the Florida Panhandle. We had estimated about $2,450 a door. I think it was 2,400 a door. In our initial estimates of where the insurance would be taken to from a current insurance of 1,200 a door. So that one we were doubling, but welcome to Florida. And so that was like our conservative approach. And then the insurance broker came back, who was like my next door neighbor, does an amazing job, gives me like better deals than he gives anybody else because our kids are friends, like all that stuff. And it came back at like 3,400 a door. And we were like, oh my God, this deal, like we've worked really hard on it and it stinks. And then our management company said, hold on, we are a big enough management company. They have about 20,000 doors under management. They had their own master policy. Okay, so they had a $50 million master policy that they put their clients' properties in, and we share some of the risk, but we also bring down the cost. The master policy price was $2,450 a door. So it brought us right back in line with our projections. And we even had the carrier give us exclusions from risk of some of the other properties in the portfolio. So the relationship part was huge. And again, it brought a 30% insurance savings to our investors.
Also, last point to this, be aware of those costs when it comes to the closing table. There's money you're gonna need that you may not realize you need, and then you're gonna get slapped with a nice bill or invoice, and it's like, good morning, congrats, my turn.
And speaking of which we, Ed and I see this a lot as agents. When you guys are underwriting your deals in your closing costs, you got to make sure that your full first year insurance premium is one of the closing costs, because insurance carriers, they get paid first. You have to pay them before you can even close the deal. And there's many teams that sometimes they won't put it there because they'll be like, well, if you look at the pro forma, like it's there in our annual expenses, but then they're using that annual revenue to pay the annual expenses. You don't get that opportunity when you're buying the property. You need that insurance money in the bank.
So this is the fun stuff that a lot of people don't talk about when it comes to the whole process. So on that note, I appreciate everyone. I hope we answered all your questions. Do you have any other?
Was that Georgina?
You're on mute.
No, that was
Okay.
great. Thank you.
Yeah. Okay. Awesome.
Thank you.
So I do appreciate the participation. I appreciate you guys all for coming on here, listening to us. I always appreciate it. This went by incredibly quick. I was surprised. I was like, wait, there's no way we're past 6 at this point, my time. But yeah, so please let us know if there's anything else we can help you guys with. Reach out to us. Our name is either behind us for Kevin, our info, or in our name for both of us. So feel free to reach out. Please connect with us. And yeah, enjoy your weekend, and we'll see you all. I know there's a call Monday. So
Yep.
See you guys. Have a good night. Thank you.
Is Monday Michael, or is that next?
Good question. Oh, I think
Keep
Michael's
an eye out on your emails, guys, because if you don't know, like for the activation Zoom coming up here, we're going to have Michael Blanc, who is the author of some of the major models that we use in underwriting. And he's going to be interviewed by Trevor. It'll be a good episode. So keep an eye out for that email.
Take care, guys. Thank you.
Thanks.